Good morning, everybody, and welcome to today's Morning Blast with myself, Ryan, and of course, Michael. It is January the 20th already. Not sure where the year's going already. It doesn't bode well for the year to come, I guess. There's plenty going on. As usual, myself and Michael suggesting what's been occurring in the markets and also looking ahead to dispelling some myths, trying to put some sensibilities on what's going on, but also in our usual eclectic tone. What's the phrase? We cater to all brows, both low and high. I hope you put a smile on your face and a bit of value into your day. Reminders that there are trigger warnings and trigger words applied on this. We don't edit this at all, so do try and keep away from minors in general. Oh God, and nothing we say on this is trading or investment advice. And on that, Michael, how are you?
A very good morning to you, Ryan. Good morning, everyone. Happy 1-year anniversary of President Trump's second inauguration.
Oh, well, great. Maybe
feels like it's been about a decade.
Maybe he should use this as an opportunity to pump the stock market. Say like, you know what, all bets are. I was only joking, lads. Also, Trump,
considering that futures are trading to fresh lows as we speak, they do with all the help they could get.
Well, this is it, but again, you got to start low to make it look better when you pump it higher.
This is true.
And they did say, was it yesterday or on Sunday, they did put out a tweet basically boasting about the number of all-time highs in the stock market and saying the best is yet to come.
Yeah, it did annoy me that they included the Dow in that, but if you want stronger evidence that there's a Trump put, then just show someone that tweet, I think.
Well, exactly that. So anyway, before we crack on, let's go through the market updates and what levels to be watching from our good friend Clive Lambert of Futures Techs. So from Clive, the week obviously we do post his chart wraps and stuff, but also do check him out on Twitter, etc. Starts off, weaker tone in equities continued in the last 24 hours. S&P is still above the supports at 68.67 and 68.41. Unfortunately, I've just been informed that he does include the Dow in his wrap. So just close your ears for this next one, Michael. The overnight through 49,001 in the Dow futures is a small sell signal if sustained once the day session trade kicks back into life. Just a note on this, obviously, remember that basically the US haven't been back officially until 2:30 today, UK time. So could be, we get them coming in and wading in and with both hands lifting everything. So, well, fingers crossed. NASDAQ, that's testing support at 25,225. DAX, keep an eye on that. That's at 24,864. Well, these are levels to watch, 24,864 and 24,618. Bund futures didn't sustain yesterday's bid, but now expect to see weakness in the coming weeks back to December lows. T-note selling off back to levels last seen in August of last year. Euro-dollar continues its nice bounce from its 200-day simple moving average, which appears to be averting the threat of the head and shoulders for now. Bitcoin, that dipped through 91,000 overnight, so continues to shy away from its 98,000 Fibonacci level that we were mentioning last week. Broken record time, gold and silver made all new all-time highs again overnight. Don't fight it, in Clive's words. LME, London Mercantile Exchange, or Metals Exchange, base metals steadied the ship yesterday. Platinum and palladium over on Globex or NYMEX, whatever it is. What are they trading at? COMEX, that might be one over there. I don't know.
Say enough acronyms, you'll get there eventually.
Well, the thing is, CME bought them all and it all trades under Globex now anyway, doesn't it?
It does, yeah.
Platinum and palladium look like they might be gearing up for another leg higher. WTI and Brent did very little yesterday, still favouring the bears here, with Clive still favouring the bears here. I'm on the other side of that one, so interested to see how that one plays out. I can't pick my nose at the moment, so probably go with Clive's assumption. Henry Hub, which is obviously nat gas, bid again overnight in Fibonacci resistance at 3.776. Obviously had this colder weather come into the States, which gave it a big old erection yesterday on the open. EU carbon market sold off yesterday and has started today in the same vein. Speaking of erections, testing and breaking an uptrend line at 86.85, maybe finding support at the 50-day simple moving average at 86.00. And finally from Clive, TTF, which is European benchmark gas, bounced from yesterday's early low at 33.11. We're still with the bulls on that one. So thanks for that, Clive. Michael, what's been perking your interest over the last 24 hours?
Good stuff. Thank you, Ryan. Well, I'll tell you what has actually piqued my interest over the last, well, this morning, actually. And we'll get onto the Greenland stuff in a while because we obviously have to talk about that. But it's actually what Clive alluded to there with that big sell-off that we've seen in duration. Obviously, Treasuries in terms of yield, moved higher across the curve. I think the benchmark 30-year yield is this morning at its highest level since September last year. But it's Japan where the real focus is. I mean, it was a bit of a bloodbath, to be honest, in terms of the long end of the JGB curve overnight. The 30-year yield rising 25 basis points, the 40-year yield rising by 30 basis points to record highs of 4.23%. And I believe that's the highest yield, maybe not ever, but certainly in a bloody long time, of any Japanese fixed income security. So safe to say that Japanese participants are having a bit of a tantrum. There's a few reasons for this, and I think it's important because without wanting to become one of these, sensationalist people who you see running around on Twitter all the time going, oh, Japan's going to implode and it'll be the end of the world. I don't think that's going to be the case, but there are undoubtedly some ripple effects from what we see in Japan and in Japanese fixed income in terms of markets elsewhere. This has all stemmed from yesterday's announcement from the Prime Minister, Takaichi, who confirmed that she is going to be calling a snap election. That will be officially called when Parliament returns on Friday, with that election to then take place on the 8th of February. That in itself is nothing new. Obviously, we've been talking about this potential election for a few weeks now. What is new is that the Prime Minister has actually more explicitly outlined her fiscal policies. And unsurprisingly, they are relatively loose, including she was talking about suspending sales tax on food and various other bits and bobs. And she also explicitly said, I might as well just quote here, we will end excessively restrictive fiscal policy. Well, that's like a red rag to a bull, or a bear in this case, to be completely honest with you. If you look at the Japanese bond market, when you add that to the fact that she said that yesterday, you then had a 20-year auction today, which went down pretty poorly. Bid cover was still 3, which isn't bad, but the average has been about 4.5 in recent months. So again, just signs that participants are getting a little bit of indigestion, getting a little bit spooked in terms of some of this Japanese supply and the rhetoric that we see coming out of Japan. And as a result, that is putting pressure on duration pretty much everywhere. As I said, 30-year Treasury yields now up by about 10 basis points on the day, 30-year gilt yields up by 6 basis points, 30-year in Germany is up by 7.5 basis points as I speak. And I think that may also actually be contributing fairly significantly to some of this more recent pressure that we've started to see make itself known in the equity complex, because actually a lot of the kind of de-risking on the whole Greenland issue would probably have been done yesterday. There hasn't actually been much by way of concrete progress on that front. There has, of course, been a lot of rhetoric. Trump this morning confirming that he is going to meet NATO Secretary General Mark Rutte and various other parties involved in this.
Just on this.
Go on.
Trump has broken like the man code here massively over the past 12 hours or whatever.
Well, with all these WhatsApp screenshots.
You do not share WhatsApps that you have with your mates. Do not get into this habit. It's a very bad habit because things are said. It's the unwritten code.
Yeah, he's acting like a scorned ex-girlfriend, posting them in a girls' group chat or something.
Or boyfriend,
we're all inclusive. Yeah, it's bizarre, frankly. Really is bizarre what he's doing there. But I think, setting that aside, which is just weird, the core message is that there hasn't been any retaliation in terms of tariffs or in terms of threats or anything like that. And also, it is very clear that European leaders are trying to pacify Trump and give him some off-ramps and make some progress towards negotiations, et cetera, et cetera, et cetera. And of course, we also heard from Treasury Secretary Scott Bessent this morning, who was talking about how retaliatory tariffs would be, in his words, unwise. He was also very much trying to dial down the temperature a little bit, urging people to take a deep breath, to let things play out. And he's also saying that he is confident that leaders will not let this escalate and that everything will work out well.
So on that, again, maybe I'm just maybe I'm just the optimist in the room, but I really don't get this kind of almost like this second leg lower we're seeing in equities over the last few hours. Because if anything, I think it's very clear that no one wants this to go down a tariff route or a trade route, and Trump is providing off ramps, and there are plenty of off ramps there. I hate to say it because if I say it, it will jinx it. But this does feel very much like a very nice dip opportunity to get long. But again, not trading advice. I just I don't think
I would
we're in the
agree with
same
that.
situation as we were like last time when the tariff, the big boards were coming out and the tariffs were all of this. And even then, they all got kicked down the road. Nothing's going
Yeah,
into effect until February the 6th, remember, if at all. And I think this is just, as we said yesterday, this is, for me personally, being teed up to be another escalate to de-escalate and all-time highs by Feb or something silly like that.
Yeah, and I think the Liberation Day stuff was different because at that point it was, holy shit, this is real. This is going into effect next
Yeah,
week. This, we hadn't been conditioned that
well,
this was a
quite.
negotiating tactic at that point. That was
Yeah,
a true out and out sort of bolt from the blue. Now, 9 months later, you'd like to hope that participants could adopt a slightly more rational mindset and actually realize that, this is just how Trump does business these days. I think there needs to be a separation because, and actually Helen Thomas at Blonde Money pointed this out either this morning or last night, I can't remember. Understandably, emotion is running quite high around all of this.
yeah,
Is it the end of NATO? Is Trump, doing Russia's bidding? Is he trying to tear alliances apart from the inside? Except, Europe should stand up to the bully. This isn't my view, by the way. This is just kind of the prevailing sentiment on
yes.
the internet.
Don't worry, Michael. We're not holding you to you.
No, before anyone quotes that. But I do think people are potentially letting their emotions just get in
Yeah,
front of the reality here, which
absolutely.
is that actually it is. Yeah. And if in 2 weeks' time there is a 10% tariff on imports into the US from Europe, then I'm going to happily hold my hands up and say, well, I got that one wrong, because that's just the nature of the beast. But I do
Mate,
feel like people are losing sight of how this sort of thing works. And sorry, just to finish up with this,
yeah,
a
go on.
really good example of this is there's been some news reports doing the rounds this morning, and to basically quote them verbatim, it says Trump threatens 200% tariff on French wine. That's not what's happened. If you watch the clip, what happened was Trump was asked about why his view on Macron not joining this board of peace that Trump is setting up. And Trump just turned around and quipped with a massive smile on my face, well, I bet he'd join the board if I throw a 200% tariff on his wine.
Yeah.
The bloke was messing around, for God's sake.
Well,
I think everyone just needs to, well, really, to quote Scott Besson, take a deep breath, take a step back, and just realize where we actually are here.
so two things, and I'm going to lead with the first one, which is, oh my God, I can't believe we're looking to Bezant as the voice of reason.
Well, yeah, there is
Um,
that.
but
That
this
says it
this
all,
kind of
doesn't it?
this going kind of shower and bleach after that moment. But no, I make you exactly right. Again, we're teeing this up for massive egg on our faces, both of us. And look, it won't be just you holding your hands up; it'll be me standing right next to you, holding both our hands up. But no, I think, like you said, people are getting far too emotional in this. People are getting very excitable, and that seems the way recently. Again, with the rise of all the social media tourists and stuff. But on the plus side, it does mean that there's lots of opportunities in the market for those that can potentially see through this, hyperbolic action. He says as he starts wading in on IG or Pepstone or other brokers are available. But yes, anyway, any more from you before we crack on with the topic of the day?
Yeah, I did have a few other things I just wanted to
Go on.
mention very briefly, just away from the geopolitical side of things. Obviously, we spoke about the political situation in Japan. Just a couple of bits to note here in Europe. Firstly, the French Prime Minister Le Cornu is going to use something called Article 49 Spot 3 to pass their budget. That basically means they can pass a budget without the need for a vote in Parliament. In theory, that could spark no confidence votes, but the socialists have said that they will abstain from a no confidence vote, but they wouldn't vote in favour of a budget. But they're not going to vote to get rid of the Prime Minister because he's made concessions in that budget, but not enough concessions in order to win their vote in favour of that budget.
There's a quiz at the end.
I mean, if this sounds very complicated, do remember this is France, so it's kind of normal service for this lot. Fundamentally, a lot of political noise, nothing's really going to happen, and they are going to get that budget through. The other thing in the Eurozone is that the Eurogroup, which is obviously Eurozone finance ministers, they picked a guy called Boris Vujic last night to be the next ECB vice president. He has been running the Croatian Central Bank and obviously a governing council member of the ECB since all the way back in 2012. He is due to replace Luis de Guindos as VP at the end of May. He has typically leaned hawkish in his votes as a governing council member over the last decade or so. And just lastly, on the subject of monetary policy, the Associated Press were first to report yesterday that obviously we have this Supreme Court hearing tomorrow in terms of Trump's attempted firing of Lisa Cook. Well, there is going to be a very important spectator in the gallery at that hearing, and that is the main man himself, Fed Chair Jerome Powell. He won't be making any comments at that hearing, as far as I'm aware. It's more a case of being there as moral support for Cook, and I guess also to kind of stand up for himself, given that Trump is also turning the DOJ on Powell as well. So that's something to watch.
I wonder
tomorrow. So.
He should wear like a white T-shirt with like "Free the Cook" one or something like that.
What, like those Free Nelson Mandela T-shirts?
Free Nelson Mandela.
I'm sure Del Boy could knock something up quickly if we needed.
Exactly. Is that you done?
It is, yes. Cool. That is me.
Well, don't get used to this, ladies and gents, and please don't send in too many requests. But we have taken a request on what to talk about today. That's regarding the quote, Europe should weaponize treasuries, which is kind of now doing the rounds a little bit, not helped by Deutsche Bank chief FX Bod. So basically, a bit of primer where what we're going to be chatting about. Trump wants Greenland. Obviously, Europe said no. Now the hot takes are flying. We've had the quote, Europe should dump its treasury holdings to punish America. That's the Deutsche Bank FX chief. Call it weaponisation of capital. And obviously, headlines are now screaming about a $8 trillion weapon. Here's the problem. And Michael, and we'll go into far more detail about this because he is the smarter one in the room. This threat has been made for 15 plus years by multiple people, i.e. China and Europe, and it's never worked. China held this gun to America's head during the 2018-19 trade war, didn't pull it because the mechanics they don't work. You torch your own portfolio, you shrink from your own currency and you hurt your own exports, basically. The real question isn't whether Europe could monetize treasuries, it's why anyone thinks this is a credible threat when the country that actually tried this dance, China, exposed how little impact it has. Now, I, for one, personally think this is kind of just a bit of hyperbole. It's going. People love this for clicks, right? And I do feel like Deutsche Bank's Saravelos has just said this just to get his note out there. Kit Jukes, SocGen's top man, very, very smart cookie, as he said, only works if, quote, foreign holders are willing to suffer financially, which Europe isn't. I just think it's neat. I just think it's an absolute ridiculous take that they would do this. Well, what are you thinking?
Well, yeah, I agree. I mean, we'll get into the mechanics of it in a second. I think the three things I would say, firstly, are one, I fully agree with you. I think this is coming from the Standard Chartered School of Research, which is say something outlandish so that we get our name in the newspaper.
What you mean, fit by a million in a week's time?
Yeah, exactly that. And to be fair to Saravelos, it's worked because it has been all over the media. Secondly, I think it speaks to what we were saying, literally 5 minutes ago about people getting too emotional and too kind of het up about the whole situation. Again, take a step back, look at things more rationally, and you realise that this really doesn't add up. And thirdly, I'm slightly annoyed with Mr. Besson because I had all my notes ready to go this morning, and then he stands up on stage in Davos at 7:30 and tears the idea apart for me. So you could just go and listen to what Scott Besson had to say, which was to coin some of his phrases. He said that the idea of Europe dumping treasuries is, quote, a false narrative. And that's absolutely true, because if you dig into the numbers, the total holdings in Europe of US stocks and bonds, because you can't really split the data out, gets you about $8 trillion, which sounds like a lot, but it's not all in treasuries. So don't get too excited about that. You've then got to remember that the vast majority of that is going to be held by private funds, private individuals, private investors. Now, you cannot well, I suppose you could, but it's very, very difficult to compel those private investors to make an investment decision based on what the government tells them to do. We've actually spoken about this recently in terms of some of these Trump trade deals. Private investment into countries can't just happen because the government says it's going to happen. So that's the first problem. You've then got another mechanical issue, which is that actually a lot of these US Treasuries assets that are domiciled in Europe are not necessarily owned by people in the region, which again takes another chunk away from that amount that you're supposed to be weaponizing here. And then you've got the mere fact that actually for the last year, pretty much every man and his dog has been trimming their exposures to the US anyway.
Yeah.
So the amount that you can, quote unquote, weaponize is even less. So that's the first part where this whole idea begins to fall down. Just mechanically, the amount is nowhere near as big as Deutsche or Tausing. And secondly, the actual mechanics of it would pretty much never work because you're forcing private individuals to sell their portfolio holdings.
Yeah, quite. Just quickly on that. So I did do some kind of rummaging this morning, not in my pants, but actually online for some data on this. So I did find a number of 3.6 trillion, which is a European-wide Treasury holdings. That's from CEIC data from November 2025. So we have like a rough idea, but like you said, people love bigger numbers, right? One thing I want to put to you before you go any further, the real risk, it's a massive if, and I'm doing the hugest air quotes ever, if there was something, Europe wanting to start moving away from de-dollarization, et cetera, I would say the bigger issue, the real risk, is refusing or reducing the amount of new issuance that you buy rather than what you sell on your books.
Yeah.
If Europe or European countries and whatnot decide to buy less, then that will have impacts on the auctions and stuff. And I think that would be more telling than, coming to market and offloading it, which, is a bad idea.
Yeah. That's absolutely. If you wanted to go down this path, which is a very foolish one to go down, that's the way you would do
exactly.
it. You would just pull back your participation at auctions. I am actually. And that's actually what the Chinese did, to be completely honest.
And they wound down from in the trillions to it's like 683 billion now or something like that.
Yeah, they've just done it kind of gradually over time.
Yeah, all they've done is buy less.
Yeah, exactly. But if you assume that you could do it in terms of weaponizing these holdings, just to go back to sort of first principles here, it's quite frankly a mental idea to do it because let's just follow the mechanics through. And with the caveat that this isn't going to happen, and I don't think it's ever going to happen, you want to dump your treasury holdings en masse. And this applies if you're Europe or Japan or China or whoever. Well, the obvious impact is that it's going to send the price of treasury bonds massively lower because a huge amount of supply is coming onto the market. Obviously, price moves inversely to yield, so that's going to send yield considerably higher. Yeah. Literally, we are seeing today how global fixed income markets are all linked and all correlated. There is absolutely no way that if you send a 30-year treasury yield 20, 30, 40, 50 basis points higher, that's not going to add a fair few basis points on to a 10-year Bund or a 30-year German yield or even gilts or even JGBs. Everything is interconnected. So you've got a huge spillover impact on that front, which will firstly pose a significant headwind to growth because you're materially tightening financial conditions. And secondly, it poses a massive risk to financial stability because you're introducing a huge amount of unnecessary elevated realized volatility into your own fixed income market.
Oh, that little phrase there made my willy move.
Oh, God. So you're basically shooting yourself in the foot by doing it is the first issue.
Quite. So who's going to be one of the first people to come a cropper on this would be European pension beneficiaries.
Exactly that. And then the other people who would naturally come a cropper on this is any European exporters because, okay, fine, I've sold all my treasury holdings. I've now got a pile full of dollars, for want of a better word. Well, the whole premise of this is to weaponize my cash, so I don't want to hold it in dollars anymore.
Buy euros.
I've got to bring it back into euros because that's all I want. Well, what do you reckon would happen if, there's $3-4 trillion worth of demand for euros? Well, euro dollar is going to move and it's only going to move in one way. So you massively strengthen your own currency, which then kills your export market.
Yeah.
So, I think it's, in short, a headline grabbing idea because the numbers involved are big and everyone wants an exciting narrative that isn't just they'll slap some tariffs on
Yes.
going the other way. But in reality, none of this is ever going to happen. And if anyone is stupid enough to seriously consider it, then, they are literally self-sabotaging.
Well, quite. And like I said, yeah, there are ways longer term that you could kind of pull something like this off, which is what we're seeing with China, as we've just said, which is you just buy less going forward. You don't come to market, and start fucking offering them out. But yeah, and I think it's another example, Michael, something that we're quite a big fan of between us is when shit starts flying and things get excitable, people's masks slip, and you see some people that kind of claim to know what going on, and they're kind of trying to be accurate and all this stuff, and then they start throwing around stuff like this. You kind of think a little bit less of them, shall we say?
Yes, I would agree with that. Anyway, shall we move on to today?
Yes, it's all going to be a headline risk, basically.
Well, I think it is, although there are a few bits and bobs on the docket just to run through. I can't believe we've got 26 minutes in and not mentioned this morning's UK labour market data. Well, it may as well. Unemployment held steady at 5.1% in the 3 months to November. Earnings growth, or regular pay, I should say, came in at 4.5%, bang in line with expectations. Again, though, big divergence between the public and private sector on that front. Private sector earnings rose by 3.6% on an annual basis, which is basically now a level that is compatible with the BOE's 2% inflation target being achieved over the medium run. Public sector earnings, though, rose by almost 8% on an annual basis. Now, yes, there is some base effect that is skewing that number higher, but that is, frankly, an unsustainable situation, and it has been for some time now. In terms of the more timely data, payrolls per the PAYE data, they fell by 43,000 in the month of December. That is not only the fourth straight monthly decline, but it is also the biggest 1 month fall in that metric since November of 2020. And if you think back to what was happening at that time, that was around the time we went into our second COVID lockdown. So very, very worrying signs indeed for the UK labour market.
Have you spoke to your mate Tris yet?
Oh, no. Oh, God. I showed him a chart of the unemployment rate over
I know.
the weekend.
I'm aware. I went to reply to it, but because I'm blocked by him, I can't even reply to you replying to him. I was very distraught.
Do you know what? I actually sat there for about 20 minutes trying to type something out, and I went, actually, this fella's reply is too moronic. I can't say anything to it.
There's no point. If anyone's wondering what we're talking about, so there's a guy called Tris Osborne, who's a UK Labour MP, and he's always come out with the world's worst takes about why everything in the UK, what Labour are doing is fantastic. And apparently the fact that since Labour have been in, unemployment and kind of payroll data has gone south very quickly at an alarming rate. Doesn't matter because apparently it's the lowest it's been in his lifetime.
Yeah. Bizarre. Anyway, in terms of the day ahead, I'll do this relatively quickly. 10 o'clock this morning, we get the latest ZEW sentiment surveys out of Germany. Do just know when interpreting this data that the survey will have been concluded long before these latest tariff threats. So the expectations metric, which is seen rising to 50 from a prior 45.8, is perhaps displaying a little bit of false optimism. Other than that, obviously, all eyes on Davos. Of course, Trump will be flying in at some point. Speeches at Davos today include those from Ursula von der Leyen of the European Union, French President Macron, and Treasury Secretary Scott Bessent is due to be speaking again. And then into the afternoon session, bear in mind that the Supreme Court are meant to be issuing opinions at 10 o'clock this morning Eastern Time, 3 o'clock this afternoon here in the UK. Again, they could issue a ruling in the IEEPA tariff case, but as always, the Supreme Court never pre-announce which cases that they will be ruling on. So it's very much a case of wait and see on that front. It could be third time lucky, or they could leave us to wait even longer. And then on the corporate earnings front, do bear in mind that we get earnings after the close this evening from Netflix, and options on Netflix are pricing a pretty punchy 7% move. So that could be one to watch in the aftermarket session. We also hear from United Airlines after the close as well. Obviously, Delta's results were a bit mixed last week, so potentially United could encounter a bit of turbulence as well.
Well, thank you very much for that, Mr. Michael Brown. Listeners, whatever you're doing today, we do hope you keep it tight, stay safe. Hopefully, as usual, we've added some value to your day. Yada, yada, yada. Yeah, whatever you're doing, stay out of trouble. Keep an eye on PIQ Suite and on the app, etc. for Trump updates and Davos updates. And, of course, Michael's Twitter feed. And we'll see you all bright and early tomorrow. Much love.
Bye for now.